Welcome to the Lobster Talks by Lobster Capital, where usually we talk with YC founders, but today it's very different. But I'm super excited. It's going to be awesome. I have today the pleasure to have on the podcast Johannes Hatt, who is an investor in startups and in funds. Johannes, thank you so much for being here.
Thanks for having me, Gabriel. Looking forward to our discussion.
Awesome. Let's just dive in. So, as I said, you're not a YC founder, you're a YC investor indirectly, for sure, and you're an investor in general. Start maybe by giving us an introduction. And you're an investor now, but you were an entrepreneur. So, we're going to explore all of that. So, tell us about yourself.
Yeah, cool. I'm Johannes. So, kind of having a background in business education, studied in Paris, Oxford, and Berlin. Then did a couple of years in consulting before starting my first company in 2008, so quite a while back. And fortunately enough, I've been able to build a couple of successful companies, two marketing technology companies that are sold to a large publishing house. And then I started a software as a service company, scaled that to 300 people, 30 million in ARR, and kind of did a couple of secondary exits and stuff like it. So I always invested that money back into the ecosystem of early stage companies. So right now I'm an LP in 10 plus funds and have done 80 plus direct investments into early stage companies.
Wow, that's awesome. I mean, just this, it's now if the listener is not hooked, is like this guy had a business for 30 plus million and then another that you sold and LP into funds and started. So that's amazing. Congratulations. I'm so honored and happy to have you on the show. So what types of startups and what types of funds do you invest into today?
Look, I think also there's an evolution, right? So I've done my first direct investment back in 2016. And I think the way I invest now is different to when I started. And I think that the same holds true for funds, right? So I think maybe if we separate them and start with direct investments, right? So I think when you start off as an entrepreneur turn angel investor, so what do you look at? Do you look at basically the deals which are shared in your network, right? So you don't have a proprietary deal flow, you don't have a kind of a way of analyzing companies, you don't have a lot of comparison, so to say, right? And I think now over the last close to 10 years, what I started doing is understanding better the mechanics behind venture capital. Also, seeing more deal flow is allowing me to hopefully pick better companies, right? So because you just have a bigger, n of compare different companies and their trajectory, and at the same time also, I mean, what I call it is a checklist, right? So I have kind of a small investment memo, and I always ask myself the same questions for every company so that I make them more comparable. And I make sure that in a moment of excitement where I see cool founders, cool idea, I'm not like, yeah, okay, I'm gonna write a check, but I make sure that I always think about the same questions, right? And I think now taking that and applying it also to LP investments, I think also there, what I look for now when I invest in a kind of in a fund is primarily what is this thesis, right? Is that differentiated? And most importantly, what is the source of deal flow? Like, where will they get the next big opportunity from, and why are they going to be able to invest, right? Because the two criteria for me are seeing the most promising companies and then also getting on their cap table. So that's what I ask myself when I think about potential LP investments.
Wow, that's awesome. This has given me so many follow-up questions that I want to ask you, so that's perfect. First, I mean, that's I think what the listeners are curious about. Could you share some of the things that are on your checklist for an investment for in a startup?
Yeah, of course, of course. I think there's things like which are, I would say, that you regularly see on that, right? So it's what is the market, how competitive is it, how do you build a competitive advantage also long term? What is the founding team? What are the skills of the founding team? Kind of what are the market dynamics? Is that rather blue ocean? Is that red ocean? So I think where do you differentiate in terms of product? How advanced are we in terms of the product? Is it pre-product market fit? Is it product market fit already? So I think those are the things that you generally think about when you do an angel investment. I think the one thing that kind of changed the whole way I look at companies is including an exit scenario, right? Kind of trying to understand, if that company succeeds, what do I expect in terms of return? What do I think? How big can this become? And then, funnily enough, what happened, at least for me, is you have an assumption, and of course, that's all hypotheses, right? We don't know, and it can turn out completely different. But then you look at companies, and you know their model is quite capital intensive, so they will need to do another funding round and then another one. And then you look at the case, and you think this could be fairly well a 300, 400 million euro exit or dollar exit, which is quite a success, right? So if you look, especially in the European ecosystem, how many of
Oh
those
yeah.
do you have? And even then, when you think, hey, this could be 300 million exit, and you look at the funding rounds, and at one point, you as an angel investor, you simply can't do follow-ons anymore, right? So because then you take pro rata, and it would cost you a million or two, that just becomes too expensive, and then your capital is too much tied into one opportunity. And I think then you look at those deals, and your assumption is, and your estimation is, that if they exit for 300 million, you're going to do 8x. And those are the deals I will not do anymore, right? Because that is just not enough return for the risk class that I'm investing in. So I'm really looking for those outlier cases where I think, if, and again, right? So there's 1,000 reasons that could go wrong. And I'm not trying to focus too much on the risk associated with the potential deal, but I really look at, what happens if that goes well? What happens if that explodes in a positive manner? And how can that become a unicorn or a decacorn? And then you see returns which justify the risk that I'm taking, right?
That's a fascinating point. I actually, it's something that we share, that we have in common. I I don't know. I didn't know you really thought that way specifically, but that's something that I keep explaining as well. Maybe, that's why we
Yeah.
get along so well. I want to double click on that. So many investors don't realize that VC or startup investing is a very discrete repartition gain theory. And so maybe just one outlier will make 99% of your performance probably in your entire life. That's why we see VCs that careers are defined by like one or two, huge exit. The one that is probably over 10 billion. You mentioned decacorn. Sometimes it could be 100 billion. It's a question I wanted to ask you later in the pod, but I'll ask you now because I think it's related. You're European, like me, and you're heavily, I think, investing in the US, like me. And so, is that part of the rationale? Because my thinking around it is, I'm investing in the US because the exits are bigger and they're more frequent, and there's a bigger stock market, etc. So there's a lot of reasons, but this is a big part of it. Was it part of your reasoning as well?
Yeah, I think it developed over the years, right? So the two things are, what you need in order to make the investments is kind of, you also need access to the deals, right? And that is for me the main criteria. So I screen between, let's say, 1,500 and 2,000 companies a year, right, for direct investments. And when an opportunity comes, knocks at my door from the US, I'm skeptical, right? Because I think there are far better investors over there. Why are they reaching out to me? Why are they
Yeah.
not finding potential investors in the US? So I think for me, really the key criteria is there. How do you get to see the most promising deals? How do you see the future decacorns, right? And I think that's also one of the reasons why I invested in Lobster Capital, right? It's just because you see those deals and you have the ability to invest in them, right? So I think I would even like to invest more in the US, also directly, but at the same time, we need to be fair that probably the most promising deals I will never see. So that's why I also invest in Europe, because I think there I have better access to the deals, right? But I agree with you, there is more liquidity in the market, and then it's basically also the market in itself is bigger, right? Which becomes directly accessible to you as a startup, right? So it's, I mean, of course, if you take the EU, that's comparable to the US, but it's far more complexity. It's more languages, more regulations. It's buyers ticking differently. So in that sense, the US is a more unified market. And I think if you define something and you find something that works, you're just going to scale more rapidly because the market is so much bigger.
Yeah, for sure. Okay. Do you use fund investments to actually try to get deal flow? Because you mentioned at the beginning, as an angel, you don't have deal flow and you want to have more. Is that one way you're going about it?
I think that's not so much of a strategy, right? It's rather emerging strategy. Of course, if there is an opportunity within a fund, and especially the first-time fund managers with smaller funds, right? So they also reach a point fairly quickly where they say, look, we're setting up an SPV in order to facilitate the next round or the round after. So I think I haven't strategically mapped that out, but of course, it's a nice opportunity because then the fund manager will know and see kind of the patterns and has a better visibility on is that becoming a success, yes or no, even though it's early to tell and that can always still fail. But then, of course, that gives you access to those deals with, I would say, an advantage when it comes to the information that you have around that company. So I think it's
Interesting.
definitely a legit strategy.
It's super interesting because I was, listening to you and it just dawned on me. I realized that, you and I, we know hundreds, if not thousands of angel investors, right? We meet them everywhere. It's usually people, who've did well, at least financially, you have some money to invest, etc. And so it's usually, hopefully, some pretty smart people. At the same time, I just realized talking to you that very, very few angels actually jump from being investors in funds, what we call LPs, what you did. And it seems that it is extremely smart to do that because you get, people in markets that you don't have. So many European angels like you don't have the best, I would say, access to the US. Everyone knows that a lot of things are happening there. So my question to you is, why do you think that is? And also, I see so many angels who just invest in their small network. I mean, you do this, I believe, almost full time or full time. So now you've built a big, access to deal flow. You just mentioned you see thousands of deals, but there's so many angels who see, I don't know, 50 deals per year, but still they're actively investing. So it's not the best deal flow and they don't have the idea to jump to being LP. Why do you think that is? I don't know if you have an opinion on that, but I just realized that.
I think that kind of there is little information that you can, I would say, trust on what does it mean to be an angel and how it does it work with returns, right? How do you build a portfolio, right? So I think that is something that over time only I wrap my head around, right? And then you think like, what is it actually that you need in order to generate financial returns, right? So I think there's a lot of angels who invest for a variety of reasons, like is kind of giving back to the ecosystem, being in touch with future upcoming entrepreneurs, new technology. So there's a lot of reasons why you can be involved in the ecosystem, which is not necessarily linked to financial gains. But I think if you kind of do that with the view of having financial returns which are in line with the risk that you're taking for that asset class, you need to have a more strategic approach to it, right? And I think, honestly, I think if I would have known what I know now, I probably would have never started to do angel investments, right? Because it's a tough game. It's a lot of money, which is tied for a long period of time. It's super illiquid. It's hard to predict what's going to come out of it, right? So I think, yeah, you need somebody that gives you all that information. And I think it's not readily available out there in the market. And there's also a limited number of angels, which I think are really that strategic on their investment and their portfolio. So I think putting your money into a fund is a good opportunity. But at the same time, the same question then is, how do you pick the best fund managers, right? How do you assess their deal flow? How do you assess their capability to raise capital from their investors base? So I think it's a it's a different level, but at the same time, it still is the same questions. And I think everything in venture goes back to A, having the deal in front of you, and B, being able to identify that this has potentially become really a deal that is going to return your fund or that's going to return your portfolio as an angel.
It's super interesting. I think you're right. I think so many angels are not really in this game to actually have financial gains. Otherwise, they would behave differently. But I think that's sort of perverse or something. I think it's actually a bad thing. I think everyone should be here to make money. I don't remember which economist it is that says if I go to the bakery or to the butcher and I know I'm going to have bread or meat, it's because the butcher or the baker has its own financial interest to actually be selling me that merchandise. Everyone should be incentivized with actually making money so they back the best founders, the best companies, the best outcomes. And it's not the case in Angel at all. And it's interesting as well. It's if you are serious about making money, I mean, I don't want to, make too many generalities here, but or be too generic, but you should probably be investing in funds. You should probably be investing in the US, and very very few angels in Europe do that. I wanted to return the question because you said once again it becomes back to the point where how do you find a great fund? How do you find a great fund manager? Can you share now? Maybe some people listening to us are like, okay, I'm convinced I need to invest into funds. So they're asking themselves this question: how do I pick a good fund manager? Do you have some tips to share after 10 plus investments in 10 plus funds?
Look, I think I firmly believe in a in a metric which is return on hustle, right? So basically finding people where there's 100% alignment of interest, right? So that is one of the reasons why I primarily invested in first-time fund managers, right? Because you have the highest incentive to make that work. If the first fund doesn't work, there is no fund two. So there is 100%
Yeah.
alignment of interest on that matter. And I'm not saying other people's they're not incentivized, but I think it becomes less direct correlation between your interest as an LP and the interest of the fund of the GPs within a fund. Let's take a 500 million early stage fund, right? With kind of the management fee that they're getting. They're getting 100 million in management fee. So is the outcome as crucial as if you run a 20 million euro fund? Not really, because you can manage, you can live quite well off the management fee already, right? So I think the one thing that I look at is, are the interests 100% aligned, right? And then the question is, do those people have access to proprietary deal flow? Where do they get their deals from? And I think if those two elements fall in line, then that is something I would invest in, right? And I think you can also look at the data, right? So I think same holds true for angel investments, right? So if you now look at the two ecosystems, which kind of outperform in the early stages, that's YC and that's AngelList, right? So if you have a possibility to invest in YC companies, I mean, even already by doing that, you have a higher chance of kind of succeeding with your investments in that regard. So I think trying to understand who is running it, what is their alignment of interest with my own interest, and then do they have access to deal, right? And in the end, it's a people question, right? So kind of, I'm not asking myself the question, do I give the money to Lobster Capital? That's just that's just a brand, right? I give it to Gabriel. That's a question. Do I trust that guy to multiply my money? Yes or no?
Well, I thank you very much for your trust, and I'm very hard at work to try to multiply your money. Before recording, we were talking about something that I thought was interesting. Was I'm not going to mention the specific rule, but
Nah.
you were setting a specific rule for yourself in investing, and so I was asking you about it, and then you told me, oh, rules are meant to be broken. So can you talk a little bit about that? why do you have rules? Is it like checklists you use to sort of contain yourself, and then how, when, why do you break them? Just could you talk about
Yeah,
that?
yeah, sure. So I think the what you're referring to is after now doing 10 plus investments in fund, right? I said, look, I'm not going to do fund investments anymore, right? So I looked at
That's the
the
rule.
yeah, at the multiplied at the multiple that I was realizing with the fund investments compared to direct investments, right? And I think there, even in a fund, the capital is even tied longer than in a direct investment, right? So even a direct investment in an early stage company is also illiquid, right? But there's opportunities in terms of secondary, there's opportunities in, I don't know, selling the shares in a Series A, Series B round. So I think even though it's illiquid, it's less illiquid than a fund investment, I would put it. And then you look at the TVPI that you're realizing with the funds, and then you look at the DPI, right? So I think just recently, AngelList had their annual report coming in, and if I'm not mistaken, every fund vintage starting 2017 was below 0.25 DPI. So if you
Wow.
invested something in 2017, then if you're lucky, you have seen a quarter of your investment back, right? So that tells
Wow.
you how illiquid that asset class is. So I thought for me, if I now invest in a fund, that capital is going to be tied for the next 15 years. That's a long period to have your kind of capital tied
Yep.
to one specific investment opportunity. So I said, that is the one element. Second element is a lot of funds that I see and speak to, they're not differentiated when it comes to the question, how do they generate deal flow, right? So and I'm not saying that is wrong, just saying for me personally, it's not differentiated enough. Is kind of if somebody says, look, we only invest in B2B software companies. I say, look, that's a focus, but that doesn't explain me how you're going to get access to the best deals, right? So if I understand, again, now going back to kind of the your area is somebody invests in YC. I get that. It's pretty clear, it's pretty defined. Then it comes around the question, how do you get access to the deals, right? Why are you going to be able to invest in YC companies? And if you then can explain that well, and then you further kind of reduce your risk by only investing in those who have product market fit, that's an hypothesis, right? So, and I can follow that and I totally understand it, right? It doesn't kind of immediately lead to the point that this is going to work out and that kind of you're going to pay 10x to your investor, but at least for me it's differentiated and I understand why there's a higher likelihood that you're going to show returns to your LPs than other funds. And I think that's
Yeah.
the way I approach it. So my general rule is I don't do LP investments, but if somebody comes around with a really appealing story, then yeah, I make exceptions to the rule.
It's interesting. I mean, I know a lot of people who have funds as well, and you're right. It's almost every fund is like, oh, we're B2B SaaS. That's, a few years ago. Today, it's like, oh, we're doing AI, and you're thinking, okay, you're doing AI, but like, what else? So if you do want to pitch to Johannes, well, he's not investing in funds officially, but you have to be very original in your way you get deals. Makes a lot of sense. Investing is really about getting access to the best deals. That's my entire thesis, obviously. So we obviously agree on that. We've mentioned a little bit about, or actually, I've mentioned a little about the difference of what's happening right now between Europe and the US.
Yep.
Again, you're European, still investing in Europe on the startup side, investing in the US more on the fund side, if I understood correctly. Where, if you're still investing in Europe, it's because you clearly see potential here. Where do you see potential in Europe today? And has your thought sort of changed in the last, 3 to 6 months? There's a lot of people saying US is accelerating, Europe is slowing down. Do you agree? Do you disagree? And where do you see potential in Europe today?
Look, I think, I mean, the European market is a big one as well, right? So, and there's always going to be potential, right? And I think being able to handle that complexity, kind of having, let's say, different languages and so on. So, I think if you do that well, that also is something that's going to protect you to some extent from other competitors coming from other regions. So, I'm not I wouldn't say looking at the US and seeing there's a big opportunity, I wouldn't say this means there is no opportunity in Europe. It's just harder to capture, right? I think. And at the same time, also sometimes we lack a little bit the mindset, I would say, to capture that opportunity, right? So, and it could be the other way around. So when I started one of my companies, we basically had a working prototype, so to speak, and I took a flight to San Francisco and spoke to two stock listed companies, right? One being Adobe, the other being Marin Software. And they both told me, looks interesting what you're building. One discussion didn't go progress and didn't go any further. But the second one, once we had our product out, they were selling it in the US market for us, right? So I think it's sometimes also kind of that mindset. And maybe we as Europeans should start by not being afraid of the US, but really looking over and seeing what is it that works there and how can we learn, right? I think looking at an ecosystem and looking at it at a specific point of time, that doesn't tell you if it's going to fail or succeed. It's a question how how do you adapt, how do you evolve, right? So it's kind of Darwin. It's not the fastest, it's not the strongest that wins, but the most adaptable. And I think that applies to a lot of startups and as well ecosystems, right? So I think in that regard we need to learn to get more adaptable and change quicker, right? So, and I think what really is to some extent driving me nuts is a lot of the regulation that you see, right? So I think that's really, to some extent, I understand, and I think a lot of the thoughts behind it, they're so you get regulations with the good intentions, but then you have to check what is it doing in reality, right? And how does it apply also to smaller companies? So I think we need a little bit more flexibility there. But I think definitely there is also a lot of opportunity within the European ecosystem. And they're great
It,
founders, right?
that's the thing. It's I agree with everything that you said. I think it's, we there's no fatality. We can just copy what works. And there are amazing founders in Europe for sure. It is said just by French, but it is said that French engineers are among the best in the world. Just the French say that. But talent in Europe is insane, and obviously absolutely not just in France, but all around. At the same time, I think sort of US is sort of this eternal startup state. We see it now with Trump and with Doge and with AI, and they just want to reinvent themselves. And I think, I would love to hear your opinion. I think Europe actually doesn't want to change. I mean, in France, for sure, when you try to change anything, there's, massive, strikes and protests and stuff. But Europe in general doesn't really want to change. What's the remedy there, in your opinion?
Look, I think so I think what we do is to some extent is we compare two ecosystems which are at a completely different point of
Yeah.
time within their development, right? So I think it's also over asked from the European startup ecosystem to be at the same point compared to the US, right? So they started way earlier. There is more capital available. There's more people who already made money by investing. There's more liquidity because there's IPOs. So to some extent, I think, I don't know how big the time gap is, but it would be fair to go back in time, let's say maybe a decade, maybe two, maybe three, and then say, how was the state of the US ecosystem back then and how is it now in Europe? So I think also if you're building a startup company and you have a well-established competitor in the market, it is unfair to say, look, that's what they're doing, and that those what are those little guys doing. It's really about the trajectory, right? So if you ask me, there's a lot of stuff that we need to change, but at the same time, I think we're on a good trajectory, right? So compared to when I started my first company, that's light years in evolution within kind of not even 20 years. So there was no ecosystem back then. It was the dot-com people. Some of them failed, some made money, and they just were about to create at least that ecosystem in Germany. So I think we need to be aware of what we are talking and what are we comparing. in order to also be fair to the European ecosystem.
Yeah, it's interesting. I agree. I mean, I remember when I started my very first business, also almost 20 years ago, I think 2009, probably. It was so different than it is today. It has changed and evolved so much. So I agree. We need to be fair to Europe and not treat it at the same level as with the US. Do you look at other markets? We've talked about Europe and US because we're European and we
Yeah.
invest in the US, and I'm here in San Francisco, but do you look at, I don't know if it's China or India or Asia in general or Africa? There's a lot of people investing there. Have you invested there as well? If yes, or if not, why?
I have invested in a fund in Africa due to personal relations to the fund manager, but apart from that, honestly, not because I'm no I'm not fit to judge what it needs to be successful in India, for example, right? I simply don't know. So I think when I look at opportunities is via recommendations from the network. And then there's a whole lot of, let's say, regulations and so on. So I think if I would invest outside of Europe and outside of the US, I would only do it in a fund, right? Because
Yeah.
otherwise it just becomes too complex.
Yeah. It's interesting. I mean, I've invested in India a little bit in the past, and I've been actually in India, and yeah, the potential is obviously insane. The human capital, there's just so many people, first of all, but also such talent. But also the country is really starting from zero almost. And I've stopped. For me, it was an opportunity cost type of thing where I think there's more opportunities in Silicon Valley. But it's always interesting to hear other people's perspective. I agree. It's a whole new country with a whole new set of rules. So going through a fund would be more interesting. Before we wrap up, I have a few, thank you so much for this and talking about this. It's fascinating. What about you personally? Are you, is there any new projects? Do you want to go back to being an entrepreneur and build, or are you just
Yeah.
being an investor for now? Tell me
No,
what's coming up.
look. Funnily enough, I'm only, and we haven't spoken since then, but only a couple of weeks now. But I'm now back in charge at my old company, right? So
Oh wow!
haven't taken
Congrats!
over position of a CEO, so I'm deep in the weeds operationally, and I think
Awesome.
that's also it's completely different, right? But I would say it's also fulfilling. And if you're an entrepreneur, I think ultimately that's what you want to do, right? You want to build, right? So as an angel and an investor, you only stand at the sidelines. So you're kind of the coach, right? And depending on the players, they ask you more or less often for input. But being in charge of a company on a daily basis, you take decisions and you can maneuver the course of the organization. So I like both, right? So it's on the one hand side is giving valuable input, but not ultimately having the responsibility. Whereas as an entrepreneur, of course, you take decisions and you're responsible for it. So I
That's
like both
amazing.
worlds.
I wanted to. I see this so often with entrepreneurs who leave and become investors, and that's many investors used to be entrepreneurs, and there's always that sort of itch that you want to scratch of investing is great, but I want to go back to building. I feel that as well, right? Even though being the GP of a fund is a business in itself, so
Yeah.
that's how I fulfill that. But so I wanted to, it's great. You're back in the seat. Congratulations. Very excited for you. Is there a book that had a significant impact on your life that you could share with us?
Look, so I think in terms of a business book, what I really like is Taleb's Black Swan.
Oh yeah,
So I think that changes a lot of kind of the perspective how you look at historical data. So I think that's really a valuable read. So that's the one I would always recommend because I think it explains or it questions a lot of common thinking that you have, and rightfully so.
amazing book. Thank you so much for that. If people want to follow you, find you, where can they reach you easily?
Best is LinkedIn, right? So I try to kind of respond to every message. So it might take a while, but I think that's the best way to
Perfect. And you
get in
actually post a
contact.
lot of stuff there as well. So you can follow Johannes's
Yeah.
ideas and thoughts on investing and maybe entrepreneurship now.
Yes. True. Good.
Awesome. Thank you so much for being here. I really had a blast. So thank you for joining me on the pod today. It was amazing.
Thank you, Gabriel, for having me.
And to our listeners, thank you for still being here, listening to us. If you're still here, please rate us 5 stars on your favorite podcast platform. It really does help. And if you're on YouTube, you can see our faces and smiles. Don't forget to subscribe to be notified when the next video is published. And until then, I'll see you on the Lobster Talks. Bye.